All right. So the reality is, I'll just leave this on this chart here. It doesn't mean anything. The reality is, there's only two reasons to buy a stock, in my estimation. And again, this is just me talking. There's only two reasons to buy a stock. One is growth. Two is cash flow. Right. I can't think of any other reason to own them other than those two things. Growth is a conversation all by itself. It still involves fundamental analysis, but for me, fundamental analysis has always been tied very closely to cash flow. If you're doing some really quick trading, some short-term trading, swing trading, your fundamental analysis might not mean quite as much. Not a bad thing to look at it and know it and understand it, but it doesn't mean quite as much unless you're starting to look at a kind of a longer term space or a longer term holding period for a particular equity. So when I look at these things, I think cash flow. Well, when I think cash flow, what is the one thing that not only just traders and investors, but regular people would think about? I remember the old stories of, my buddy's grandmother who owned Bell stock for like 64 years, right? They owned that stock because they wanted the dividend. They wanted to participate in stock ownership. They wanted to be rewarded for owning a stock. So essentially, when you start looking at a dividend, it's just essentially you give the company a little bit of money, they give you some shares, and they reward you for holding those shares. And the way they do that is in the form of a dividend. Well, I love dividends, and I love dividends because it's something that can be passive. Right? We can sit back, we can put our money to work in good, solid, fundamental companies. And we've talked, for the last 2-3 months, different metrics of what we can look at to be fundamentally sound. And we're going to continue to do that. But when we sit there and we collect this dividend, it's a passive sort of income, which is great, right? You can do this without without a lot of energy expended over the long term. Up front, obviously, we need to do some analysis, but these dividends are important. Now, the question you may ask yourself is, why are they important? Well, it's great to get a little bit of money, right? That's all fine and dandy. We can look at some of the Tackle 25, which we will do in a minute here. You can get a 2, 3, 4% dividend, 5% dividend. That's great. If you look at your other investment types, like a CD, a certificate of deposit, you're not even getting 1% these days. So getting those dividends is very, very important. But why is it important? Let me show you why I think dividends is the most important thing ever. And this, I think, will clear it up for anybody who might be on the fence. I'm sure you've all heard of our buddy Warren Buffett here. That's his smiling face. All right. I want to show you what his cost basis is of one of my favorite stocks. Okay. His cost basis of Coca-Cola is $3.25. Okay. Now I want you to see how much, let me get to the right spot here, how much of a dividend Coca-Cola currently pays. And we can find that at FinViz. I'll show you a couple of other websites. So the current dividend for, where'd we go here? $1.68. So Mr. Buffett paid $3.25 on average for his shares. He owns a lot of them. And every year he gets paid $1.68. Now, my math might not be that good, but I can tell you for certain that's over 50% return. So even if we start looking at dividends, it's not just about today and what we can get paid today, but it's how we can grow those things over time. And I think that's really important. Now, why is that important from a fundamental standpoint? Well, if a company pays a dividend, okay, there's a few different things that dividends can tell us, right? Obviously, if a company pays dividends, it's able to take some of the profits that it makes and give it back to the shareholders while still maintaining the business. That is a measure of profitability. Okay, to a certain point. A lot of companies, some companies are profitable and don't pay a dividend, and that's completely fine. But if you look at the really fundamentally strong companies, they pay dividends, and they usually have a long history of paying those dividends. Now, the really, really good companies, fundamentally speaking, are able to pay those dividends and increase them year after year. And that's what Mr. Buffett has here in Coca-Cola. Coca-Cola has, I believe it's 56 or 59 years in a row, they've increased their dividend every year. So what does that tell us about the company itself? Because this is about fundamental focus. Well, what it tells me is no matter what's happening in the economic landscape, if a company can continually increase their dividend and still show a profit each year, okay, that probably means they've either got a really good business model, a really good product, a really good management team, or all of those things combined. Okay, so looking at these things and looking at the history of how companies pay dividends is very, very important. Okay, and really what it's telling us is, again, at the end of the day, is this company able to weather, financial storms, get through hard times, and still be able to reward its shareholders? If it can, then chances are it's fundamentally strong. One of the ways we can look at this is looking at the history of dividends. Okay, and I'm going to talk about the Tackle 25 a little bit here. Dividend fireworks, some of my favorites, but I'm going to show you guys Coca-Cola right off the bat because we were already talking about it. This is one of my favorites here. So you can go to this website, dividendinvestor.com, just one of many places you can look up dividend information. Right now, it tells us that Coca-Cola is paying 2.85% yield, dividend yield. So it's important to look at the yield. But here we go. So 58 years in a row, it's consistently increased its dividend. What that tells me as an investor and as a position trader, or whatever I'm using my fundamental analysis for, that tells me that for 58 years in a row, this company has done some really good things, and they've rewarded the shareholders for that reason. Okay, now there's another metric we can look at. I look at the first dividend paid here. So these guys started paying dividends in 1893. Now I'm pretty old, but I'm not that old, right? But that's a long time to be paying dividends. And I believe, I'd have to check this, I believe it's been uninterrupted since that time. Okay, so if we look at this kind of website, this gives quick information here. You can see here that they give you a nice little bar graph here, and you can see that consistently they're increasing this. So if you think about it, these dividends are rewarding you for being a shareholder, and they're rewarding you a little bit more each year as they go along. Now, this can be industry specific. Let me show you Newmont Mining here. Okay, so this is one of our Tackle 25 stocks. Okay, now fundamentally speaking, this thing is pretty solid. Okay, but it's a different kind of company. So this is specific to dividends from this. This is in metals and mining. Okay, so you're about 3.63% return there, pretty decent return. They paid dividends since 1934, but they don't have any consecutive dividend increase. Is that a bad thing? No, not necessarily. What we do is we look at this and we look at the kind of industry that this has. And what you'll see is that the dividends kind of go up and down a little bit here. Okay, this is metals and mining. This is a business where it's kind of feast or famine with profits. And what they do is they share these profits with the shareholders, us as investors, and they share this. And sometimes it's up really high, sometimes it's a little bit low, but they consistently pay dividends here. As you can see, like I said, paying dividends since 1934. That's a good long time. That tells you something about this company, even though they're in an industry that doesn't react similar to what we saw in Coca-Cola. Okay, so the dividend part of this is, and the reason we use this is, we've been talking about ways to value companies. We've been talking about financial metrics of companies. And we're talking about stability here. When I start to look for these things, if we look at the, some of the other ones here on the Tackle 25, you've got Dow Chemical, Newmont, Viac, Verizon, HBQ, all these names you guys know. You guys know these. I'm sure you've heard these names before. They're all pretty solid names. And the reason we know these names is because they fundamentally speaking, they're quality dividend payers, even if they don't have the same numbers as a Coca-Cola. As you can see with Newmont Mining here, they've got some pretty impressive numbers here, and so we can use this dividend information to put ourselves in a position where we're buying quality stocks. And if we're holding them long term, maybe we buy them now, and yet their price continues to increase, much like Coca-Cola has, right? So Mr. Buffett had 360 for his 326, sorry, for his cost basis. And the cost of a Coca-Cola share right now, and this is after any splits, is $58, $59 here. So over time, not only does that original dividend, if you're holding it and creating cash flow with it, that holding that over time, as the share price increases, your dividend return rate, your ROI as it be, can also increase. So this is why looking at dividends and looking at the history of dividends is very, very important. Now, one of the other things that you need to keep in mind is dividend yield. When you look at dividend yield, right, you'll see that on Coca-Cola and Newmont Mining, we were right around the 3%, 3 to 4% mark. Okay, that in my experience is a pretty healthy yield for a stock. Now, what about a stock that has a 10% yield or a 12% yield? Okay, that's great to get, but what you need to do is fundamentally you've got to look at the stock to see if they can sustain that. Now, there are some that do that, but there's a lot of them that have really high dividends and then they fall off after a while. And so we can see that by looking at other fundamental metrics, as we've talked about in the last 2-3 months here, and as we'll continue to look at going forward. So comparing things, apples to apples, so to speak. We got Coca-Cola here. We'll quickly look at Pepsi here, just to, these are two that we've been comparing the whole time here. Okay, right? You're getting a 2.4%, 2.5% dividend here for Pepsi, and you've got 49 years of consecutive increases and paid there. So you've got two very similar companies here, but one's paying a little bit higher dividend, one's paying a little bit lower dividend. We can use that in our fundamental metrics, again, along with PE ratios, along with the PEG ratios, along with all these other metrics that we've been talking about and discussing. We can use these to say, okay, how solid or how stable is this company, and does it fit with my investing goals or my trading goals, or whatever your reasoning is behind this. So at the end of the day, I love the dividend because it's an easy passive way for cash flow, and it's something where we can be rewarded as shareholders. And it's very important to look at how stable a dividend is. One of the examples that I tend to use a lot is a company like General Electric. General Electric for years and years and years was a darling of the dividend world. Okay, and so unfortunately now they used to pay dividends quite a bit. They actually cut their dividend a couple of years ago. Looks like they've got one back now, but they actually cut it here. You can see, so they just recently started paying it again. That can tell you whether there's trouble in the company. And we know if you look at the headlines for the last few years, GE has struggled quite a bit, fundamentally speaking. So all these dividends can give you this inside information, to the inner workings of a company. They can't hide problems from a dividend. If they run into problems and they have to cut their dividend, that's a big red flag for at least most investors, myself included, that says, okay, there could be problems with the company. At that point in time, you can start to look at the underneath of it and all those other metrics we've talked about and really get a really quality look at a company to see if it fits the profile that you're looking for.